Good morning, everyone. This is Stephen March, and I am the program coordinator here with Freedom Tech, which is our financial loan program for people to be able to purchase assistive technology. So we're really excited to have Carmina on the webinar today because one of the resources that we actually provide with Freedom Tech, we're doing assistive technology loans, but we're also providing financial education resources. So this is one of our first presenter that has come to do one of our webinars. So we're excited to have Carmina Lass on the call from Credit Builders Alliance. And a little background on Carmina: she's the Director of Training and Consulting, excuse me, and she leads the development, marketing, coordination, and delivery of Credit Builder Alliance's education, training, and consulting services. And she also provides support to CBA, which is Credit Builders Alliance, reporter and access team, creating innovative and entrepreneurial services to meet CBA's client and partner needs and carrying out CBA's mission. So she comes with over 5 years of experience as a nonprofit practitioner, through which she focused on economic empowerment, financial capability, and lending among low-income and underserved communities. Most recently, Carmina was the Director of Homeowner Services at Pikes Peak Habitat for Humanity in Colorado Springs, Colorado. Carmina has a master's degree in conflict resolutions from Portland State University, where she concentrated on intercultural conflict resolution, dialogue and reconciliation among divided communities, and microfinance strategies for poverty alleviation. So we're really excited to have Carmina on the call, and she's going to be talking about increasing financial stability with credit building. We all know that this is a huge topic. A lot of people do not have access to education on credit and don't understand how credit works and how to build credit. There's a lot of misinformation out there. So we're excited to be able to put this information out. So thank you, Carmina, and I'll go ahead and hand it over to you to start the webinar.
Wonderful. Thank you so much to Rosemary and Stephen for inviting me to present this webinar and for putting all of this together. Really excited to share with you today a bit about the benefits of credit building as a financial capability strategy that can help people build financial stability. Just to give you a little bit of information on Credit Builders Alliance, we are a national nonprofit organization. We work with our members, all nonprofit organizations and governmental agencies across the country to help support them in helping their clients build strong credit. We have deep relationships with the credit industry, including with the major credit bureaus and the scoring modelers like FICO. So we work with them to allow nonprofit lenders to report loans to the bureaus on behalf of their borrowers and also to access credit reports. Another thing that we do is provide training services to our nonprofit members and many others. So that's just a little bit of an introduction to who we are at CBA. So today we are going to talk about the importance of credit and credit building. We're going to discuss best practices for building strong credit profiles, as well as how to identify credit building products in your local communities. We are not going to go into a lot of detail today on addressing debt and credit remediation issues, so fixing past credit problems, but that topic will be explored in a subsequent webinar coming up in March. I believe it's March 16th. So I know you might have lots of questions around debt issues, and so we'll maybe touch briefly on those, but definitely stay tuned for that next webinar, which will focus a little bit more on those types of issues. I'm just curious, so I was going to do a little poll, and actually I think instead of using the polling feature, I'll just have you type into the chat box. For those of you who are listening in, I'm just wanting to know, are you interested in learning about credit building for yourself, for clients that you're working with, or other communities that you're working with, or both? So if you just want to type in either myself, my clients, or both into the chat box, that would be great. Seeing some responses come in. I see some people are looking for both, looking for clients. So I think that it's great if you kind of have that joint mission. I think that we can always improve our own financial capability, and then use those personal experiences to continue to support others that we work with. But thanks for those of you who typed that in. All right. So I did just go through a little bit about Credit Builders Alliance, but again, our mission is to help organizations move people from poverty to prosperity through credit building, and so we really believe in supporting mission-driven nonprofits to help people do that. I won't go into a huge amount of detail on our platform, but we offer a variety of different programs and resources for practitioners, products including our Reporter and Access service, as well as a little bit of advocacy on policies that protect consumers around credit. Okay, so I want to just begin by taking a look at the root of the word credit. So a lot of times we have a lot of different types of associations when you hear the word credit. A lot of different concepts come into our minds, and a lot of times they can be negative, and with the people that we work with, they might be negative associations. The word credit does come from the Latin cred, or credit, which ultimately means trust, value, and worth. So whereas debt is focusing much more on what is negative, using too much credit can of course lead to crushing debt, and millions of Americans do struggle because they have used too much credit. But credit is really the ability to borrow money, and debt is what you owe someone or a business, when you owe someone or a business money. So a lot of times people conflate those two things, but ultimately credit, I like to think of it as a tool. Credit is neutral. With all tools, it's important to know how to use them correctly, and that is ultimately the key to success. At its core, credit allows you to buy something now and pay for it later. People trust you to pay back the money you borrow from them, whereas debt is a liability. Credit can actually be an asset. But in our economy, one's credit report and scores, or lack thereof, are used as proxies to determine accountability, integrity, and trust in a whole host of other ways, as we'll see later in the upcoming slides. So if somebody doesn't know anything about someone else, they can use credit to make a quick decision on whether or not to trust that person. So again, it's just a good idea to kind of think about how we might separate those two concepts that we often conflate. So credit can be confusing for all of us. Believe me, I work around credit every day, and I still am mystified. But we use a lot of different terms when we talk about credit. Credit history, credit reports, credit scores. Sometimes we use those terms interchangeably when they actually mean different things. So let's just briefly review some basic terms to make sure that we're all starting out on the same page. So your credit history or credit file refers to your overall experience with opening and managing credit accounts with different businesses. So you can actually think about it similar to a medical history or even a job history, regardless of what any one set of records or a resume might show. So again, credit history is your overall experience working in the credit world, so accessing accounts and loans and credit cards. Whereas the credit report is really a snapshot of your credit history at a particular moment in time and usually pulled for a specific purpose. If you have no credit history, then you ultimately will have no credit report. And finally, a credit score is a summary of the credit report boiled down to a 3-digit number designed to tell lenders or other businesses about how risky you might be to do business with. So a person who has no credit report will ultimately then have no credit score. And some people with credit reports that don't contain much information might also not have a credit score because they don't have enough information to be able to generate that score. Okay. Ultimately, though, a good credit history is crucial in today's economy. In fact, it has been said that good credit is like a passport to the new economy. Let's explore some of the ways that that works. So first, good credit equals access to high-quality financial products. Most of us require access to credit to weather economic shocks, such as an unexpected job loss, cars that break down, kids that need braces, many other things that are planned or unplanned that require the use of credit. Without access to credit, many people might depend on predatory lenders or fall into a cycle of over-indebtedness. Having good credit also helps us find more affordable financial products. A good credit score can save a person as much as $200,000 over the course of a lifetime. Consumers with good credit are often offered better loan rates. Good credit equals access, equals opportunities and options for housing. Many landlords pull credit reports to determine whether to rent to an applicant and sometimes how much of a security deposit to charge. Good credit can also reduce or eliminate costly deposits otherwise required to turn on utilities or acquire a cell phone contract. The positive credit rating may also reduce the cost of products like car and homeowners insurance. And good credit also equals asset building. A good credit history can make the difference in accessing the affordable lending products necessary to go to college, buy a home, start or grow a small business. Of course, we also know that good credit can give you an opportunity to purchase those assistive technologies that you need, as Stephen mentioned through their program. And using credit to purchase assistive technology can help build credit to achieve those other goals that you might have. So this slide compares the use of a credit card with the use of short-term credit like payday loans. A lot of times people feel nervous about opening and using credit cards because of the potential of incurring debt. But when used responsibly, at CBA, we really do believe that credit cards can be a highly effective tool for financial stability. It's just, again, important to know how to use them in a way that supports financial stability versus something that harms that. When used to bridge the gap between paydays, for example, and if the balance is paid in full, credit cards can be used effectively as a 30-day interest-free loan. And for those of us who are unable to pay off our monthly balance on a credit card, at a minimum, we can recognize that the cost benefit of owning and using our cards can be worth it, not just to pay for daily or monthly expenses, but also for the convenience and security of having that credit to fall back on, or better yet, leverage in order to make a large purchase or pay for that unexpected expense. So imagine if you don't have a credit card to fall back on as a financial management tool in the case of an emergency. Some consumers have the income, savings, and assets, or at least the family or social safety net to fall back on to weather financial challenges, but many do not. And the truth is that we live in a two-tiered financial system in which if you have no credit, it can be a huge barrier to achieving and maintaining financial stability. And at worst, to ensuring that we don't become trapped in an unsustainable cycle of debt and financial turmoil. So that access to that small dollar credit can be really, really important. And without it, a lot of people do turn to products that lead them into a path of over-indebtedness by using some of these predatory products like payday loans. But the bottom line is that a reasonably priced and well-managed credit card is definitely can be a better alternative, not just for credit building purposes, but also for long-term financial stability. So just another example to illustrate the cost of products with different types of credit scores. Good credit equals savings and can save a person thousands of dollars over their lifetime, as I mentioned earlier. And with good credit, of course, consumers are offered better loan rates. So this slide provides two hypothetical examples of the differences in cost of credit for people with poor, fair, and excellent credit. So in the first example, the example is that somebody is applying for a $10,000 auto loan with a 5-year term. If that person has a score of 500, a credit score of 500, which is deemed a poor score, they might still be able to access that car loan, but they're going to pay a higher interest rate than somebody with better credit. So in this example, they're going to pay 15%, although it's not unheard of to see interest rates much higher than that on car loans. For somebody with a 620, which is a decent credit score, not the best and not the worst, they are going to pay 9.4% interest on that $10,000 loan. For somebody with a 720, considered to be a good credit score, they're going to pay 3.4%. And if somebody has excellent credit, so over 760, they're going to pay 2% interest or even less in some places. So what that means in terms of those monthly payments, that compared to somebody with poor credit, the person with excellent credit can save $62 per month, and over the 5-year term, they can save almost $4,000, so $3,720. And so when you think about that, that $62 could be a bill. It could be a utility bill. It could be groceries. It could be many, many things. And over the course of that 5 years, $3,720, that is also a lot of money that could be leveraged. For something else, to purchase an asset, to save for many, many things. In the second example, we can look at a mortgage and how that impacts the different credit scores could impact the mortgage. So going through the same examples, I'm not going to go through each one, but ultimately, somebody with a excellent credit score compared to somebody with an okay credit score can save over $80,000 on a $250,000 mortgage over 30 years. And somebody with a poor credit score is probably not going to get approved for a mortgage in the first place. So pictured on this slide is a picture of a house, a graduation cap with a diploma, and a "We Are Open" sign for small businesses. So good credit also equals access to assets. A good credit history can make the difference in accessing the affordable lending products necessary to go to college, buy a home, or start and grow a small business, 3 of the most widely promoted asset building options across the country. And while good credit history and score can mean lower fees and interest, a thin credit history or none at all can make it really difficult to qualify for any of these high quality, more affordable credit products from traditional lenders. Okay, so let's define what we mean by credit building. So while credit building can involve credit education or credit rebuilding, so focusing on some of the past errors that might have been made on the credit history, credit building is really distinct in that it requires a linkage to an actual credit product. The focus on credit education is to help people build knowledge and skills to understand credit, and the focus of credit remediation is dealing with errors and outstanding debts. But credit building is really about establishing and maintaining active credit accounts that show up on a credit report. So we'll define what active credit means in just a moment. But having positive active trade lines on your credit report is the only way that somebody with no or with a thin credit history can establish or reestablish a credit score. In many cases, adding an active trade line is also an effective and faster first step than dealing with only with debt for those with poor credit profiles who wish to boost their credit scores. So just to put that into a context, if somebody has is struggling with lots of old credit card debt that they've been paying down, it's great to work on paying down that debt. I don't want to take any value away from that, but just doing that alone is not necessarily going to help them build credit going forward if they don't actually already also have good active credit at the same time. So what does it mean to have active credit? So we're going to first talk about installment loans. And installment loans include loans like car loans, student loans, mortgages, and they are loans that have typically a fixed term and a fixed monthly payment. So they have a start date and they have an end date. In order for an active or for an installment loan to be active and make that positive impact on the credit score, it must have a balance, it must have a monthly payment, and it cannot be closed. So if you are making payments on a car and you are making payments on time, it is in good standing, you have active credit. If you have paid off your car loan or other personal loan or assistive technology loan 6 months ago, and that loan is now closed, it's not going to hurt your credit, but it's not going to keep helping your credit move forward. You have to have that ongoing active credit. When we think about revolving credit, such as credit cards, this is the type of credit that doesn't have an end date. It's an open-ended type of credit. So credit cards and lines of credit are examples of that. You have access to a certain amount of money that you can draw upon, and then you gradually repay it. You can take out more and repay it and go back and forth. As long as you are remaining in good standing, that line remains active, so you're using it, then it remains an active line. So active revolving credit or active revolving debt doesn't need to have a balance or a payment. And what I mean by that, a lot of times people think that they have to carry a balance on their credit cards in order to build credit. But that's not the case. As long as you are using the card, then it counts as active even if you pay off the balance in full every month. So this could be if you make one small purchase every month on the credit card and then pay that off in full, that would count as active credit. You could spend $10 on an item, and then pay that $10 off in full. Every month you wouldn't incur any interest because you only incur interest as if the balance rolls over from month to month. And in order to be active, it also has to be used at least in the past 6 months, but for the best results, using that credit card monthly, it has the best impact on the credit score. So over the last 10 years, Credit Builders Alliance, we have a network of lots of different members who are working with clients to build credit across the country. And they have identified that the best practices for building credit include having 3 active trade lines, having a mix of different types of credit, so at least one installment account, at least one revolving account, and to have at least 6 months of history and activity, and ultimately for best results, pairing that, if you're working with clients, with ongoing credit education and support to help people continue to be successful. We have found that while 3 active trade lines is the best practice for the best results on the credit score, as little as 1 active trade line can help somebody establish a score if they're starting from no score at all in the upper 600s, and can help others increase their score who are starting with poor credit on average by 35 points. So even just adding that 1 new active account can have huge benefits depending on the starting credit profile. So opening and managing financial products, like we just learned, is key to building and maintaining a good credit history. However, many people don't have options or access to build good credit. So people who are not banked, who don't have a relationship with a traditional financial institution, or just are starting out with no credit or poor credit, it's difficult to be able to qualify to open those types of accounts. In fact, according to a recent report, approximately 1 in 5 Americans don't have credit scores at all. This might be because they are either completely credit invisible without any credit file at all, or because they may have credit records, but they do not have enough credit history or recent credit history to generate a credit score. We believe this slide shows that a Venn diagram that illustrates what CBA believes is the core elements required to build and establish and maintain strong credit: knowledge, access, and action. So when you're working with clients, any approach with credit, we believe that these 3 elements are critical to help people build strong credit. Knowledge refers, of course, to what you know and need to know about credit. Access refers to what kind of products you're able to open to build credit. And actions refers to the behaviors you need to maintain, such as on-time payments, to maintain those strong credit scores. So we know that knowledge isn't enough to build strong credit. You have to be able to open an account and use it. Access to credit accounts or access to credit cards isn't enough as well, because you have to be able to manage those successfully in order to build strong credit. So those are the 3 key pieces. And yet having a good or excellent credit score doesn't really mean much unless you can use it to achieve your goals and impact your financial stability. So I don't know about you, but I don't go around talking to my friends about my credit score or comparing those, because it's really, kind of a personal thing, and it's also not something we want to boast about just for the fact that we might have a good credit score. It's really what you use that credit score to access. So as some examples that are included on this slide of what a good credit score might mean to different people: I lowered my payments on insurance and loans. I've obtained the job of my choice. I can qualify to buy a home or get a small business loan. I've reduced my outstanding active debt. I went back to school because I was able to purchase a car with a low interest loan. So those are just some different examples about how having strong credit can mean different things to different people. So you and your clients might have many different financial goals, short-term and long-term, that you would like to work towards. You can prioritize these goals and make them SMART goals. And SMART goals contain specific details, are measurable, can be immediately actionable, and are realistic amid your financial situation, and can be organized into a definitive timeline. So we really think that setting those concrete financial goals is critical to credit building, and including credit building as a process in helping you achieve your financial goals. So as an example, somebody might have a goal of wanting to purchase a home or another asset, and that might be the goal, but that's not enough, and it needs to be made more concrete with a clear plan. So setting a timeline for that, setting a action plan for what to look for in the credit report to open new accounts, and that kind of thing. It's really important to also create those connections between good credit and the goals that you're aspiring to. Credit building, again, is never for the sake of credit building alone. Having a good credit score doesn't mean much unless you can actually use it. So we believe that the first step towards building credit in pursuit of financial goals is to really reframe the negative association that we have with credit to the positive focus of credit as something that is an asset. Though they're often lumped together, There are two essential tools to help a client understand their credit profile. The credit report is a type of document that presents a summary of a consumer's credit history, and a credit score is a risk model that's commonly used by lenders to assess the level of risks that they take when offering a consumer a particular loan or product. Both the credit report and score are important to understand, as both can be used as key financial education tools. So the focus of this webinar is not on reading reports and scores, but I just want to cover briefly what is included in the credit report. This slide depicts the 4 key sections that make up most credit reports, and I'll go through each one briefly. So again, the credit report is a record of somebody's credit history, meaning primarily a record of your financial accounts and obligations. And all credit reports contain the same general information. They contain personal identifying information such as name, date of birth, social security number, current and previous addresses, employers, and much more. Much of this information only gets updated when somebody applies for credit, and so it's very common to find that information is incomplete or out of date. So when people are reviewing their credit reports, it's really a good idea to understand that, but also to look at that section to look for any indications of identity theft. So information that you don't recognize at all, addresses, names, that could be an indication that somebody had compromised your identity and was trying to open credit in your name. The real meat of the credit report is in the next section, which is credit history. So this includes types of credit accounts, payments, outstanding balances, credit limits, dates accounts were opened and closed, and the current status as to whether the credit accounts are being paid on time or have late payments. Public records are also a key section of the credit report, and that includes things like bankruptcy filings, foreclosures, judgments, and liens. And finally, on all credit reports, you'll find a list of inquiries or requests for credit reports by lenders, employers, and others who've requested your report in the last 2 years. There are 2 types of inquiries that are included in the credit report. Hard inquiries is when you apply for credit and your credit report is pulled by a lender to determine whether or not to extend you credit. These are the types of applications that actually can impact your credit score and lower it a few points. It only accounts for about 10% of your credit score though. The other type of inquiry is soft inquiries, and that is when a person checks their own credit report or a company checks your credit report for informational or promotional purposes. It also includes when an employer checks your credit report or when you're pre-approved for offers of credit. So these don't affect your credit score at all. So there's a common misconception that if you pull your own credit report, it'll hurt your score, but that is actually not true. And those soft inquiries only appear on credit reports that are available to the consumers. Of course, while all credit reports contain the same general information, different reports may display information differently, and some don't display information at all. So it can be tricky. In an ideal world, all credit reports would look the same and we'd know how to read them. But it's important to kind of get to know how the different reports look like when you pull them from your annualcreditreport.com. So I can definitely make this flyer available that includes information about how to access a free credit report. Every person is guaranteed the right to access one free credit report from each of the 3 credit bureaus once every year. And you do that by visiting a website called www.annualcreditreport.com. They can also be requested by phone, by mail, or by fax. So if you haven't looked at your credit reports ever or in a long time, sometimes it's a good idea to pull the credit report from each of the 3 major credit bureaus, which are Equifax, TransUnion, and Experian, in order to get a comprehensive picture of your credit. But once that's done, consumers can actually monitor their own credit over the course of the year by pulling one credit report from each of the bureaus every 4 months. And that will give you an idea of what's going on with your credit, make sure you're looking for any inaccuracies without having to pay for any type of service to do that. You can do that completely free. All right. So I talked a little about credit reports, but I want to now just shift over and talk a little bit about credit scores. So I have a little quiz, and if you can just use the chat box to type in the answer. How many credit scores can one individual have? And the answers are A, 1, B, 3, 1 from each bureau, C, no more than 20, or D, too many to count. So type in what you think is the answer, and I'll give you just another moment. I see some mostly D's and B's. All right. Thanks for responding to that. So the answer is actually D, too many to count. So there are actually thousands of different scores out there, and it can be very confusing for consumers to understand. The graphic on this slide illustrates the different types of businesses that use, how different types of businesses use credit scores to assess different types of risks, equaling thousands of different scores. Lenders use different scores to measure risk for different types of lending, and basically they're looking for slightly different characteristics in borrowers applying for different types of loans. And the risk score modelers, or the companies that create credit scores, have developed different calculations to account for those differences. There are many different types of credit scores. There's 2 primary companies that generate those credit scores, although the credit bureaus, Experian, Equifax, and TransUnion, also have their own models. But you're probably familiar with hearing FICO. FICO is Fair Isaac Corporation, and they create the most widely used credit scores in the lending industry. Mortgage lenders in particular use FICO almost exclusively for their underwriting purposes, so qualifying for people for loans. A Vantage score was created in 2006 jointly by the 3 credit bureaus, and they try to design Vantage score as an alternative to FICO and designed to be more of a consumer-friendly type score. So when you look at websites like Credit Karma and other websites that give you those free scores, those are typically Vantage scores. So just thinking about how we understand scores, generally, I'm just going to go through this kind of quickly because I know we're getting short on time. But generally, the lower your score, the more risk you are, and the more you'll pay for credit. And the higher your score, the more you're viewed by lenders as being a good credit risk, and so you're eligible for the best rates and terms. And then there's a whole spectrum where people fall in the middle of that. To get a sense of U.S. consumers, where they fall, about 1 in 5 Americans has excellent credit, and just a little bit more of the same people have the same number of people have poor credit. So about 3 out of 5 Americans are somewhere in between. So I'll just go through quickly what this looks like in terms of having so many different credit scores. So let's take this hypothetical person. We'll name him Javier. Let's say he was denied for an auto loan, and his lender, when he was denied, provided him a credit score. And so it was based on a FICO score that came from information from his Equifax credit report. And he's frustrated because he really thought he was going to get that loan. And so then he goes online and uses Credit Karma, and he pulls a credit score there, but this time he's receiving a Vantage score using data from TransUnion. So he's confused because that's a totally different score than he got from his lender. Later down the road, he does some work on improving his overall credit history, and he applies for a personal loan at his local credit union. They use a FICO score as well, but this time it's using data from experience. So you can see how this can be confusing to navigate, and how we help somebody work towards improving credit scores when there are so many scores. We think it's important to focus ultimately on the overall trends, and so focus on the key actions that you can take to improve credit scores across the board. All scores are slightly different, but we do know generally the key things that matter. So this gives you an idea of, from the FICO score, the key factors that are relevant to the FICO score. So the most significant factor for the FICO score is payment history. Okay, so there are 5 total factors, and the number 1 factor for the FICO score is worth about 35%, and that's the payment history. Basically, the score is looking at whether you've paid back the debts that you owed, and if you were on time in paying them back. If you have a history of late payments or collection accounts, the more recent of these negative items, the more recent these items are, the more they impact your score in a negative way. So even if you have missed some payments on active accounts, getting them back on track will ultimately help the score. The next most significant piece of the score, worth 30%, is your amounts owed, or your outstanding debt. And so this considers total amounts of debt owed, but also heavily weighs the amount of outstanding revolving debt as compared to credit limits. So this is called credit utilization. So the standard rule of thumb is to keep your revolving debts under 30% of your total credit limit. As an example, if you have a credit card that has a $1,000 limit, the rule of thumb is you want to keep that balance under $300, under that 30%. The next factor, the key factor, is the length of credit history. And this takes into account the oldest open accounts that you have, but also the overall age of your accounts. The more positive history, the better. So ultimately, young people and those who are new to credit, part of it is just needing to wait it out. But for those who do have credit history, people can avoid closing old accounts, as this could negatively impact the length of credit history. And then the last 2 components are new credit applications and credit mix, both worth 10% of the score. So new credit is influenced by the number of applications for credit accounts that have occurred in the last couple of years. Applying for lots of credit is seen as risky, so it's recommended to only apply as needed. And for credit mix, people with the strongest credit scores have a mixture of different types of credit accounts, like installment, revolving, and mortgage loans, showing that they can successfully manage different types of debts. This is a FICO model, obviously, and VantageScore has a slightly different model of calculating their scores, but there are many similarities in what types of behaviors are most important, namely that payment history is the number 1 factor for both of those score models. Okay, so our best practices, knowing these trends, if you can work towards these best practices, generally you will be improving your credit scores across the board. So the best practices for building strong credit are to maintain active trade lines and always pay on time and regularly. Keep balances low, ideally under 30%, but anytime you're lowering your balances, that's going to help the score. Don't close old inactive accounts in good standing if you don't need to. Maintain a mix of active trade lines, and don't open more accounts than you need to. Okay. Since I'm running a little bit short on time, I'm going to skip through a couple slides, but hopefully we can make the slides available to you after the presentation. So just bringing the conversation back to credit building, knowing what we need to do to build strong credit, namely have good open accounts. We want to make sure that people are ready to get set up for those accounts and to be successful with those accounts. So before you are opening any new account or you're referring your clients to own a new open a new credit account or loan, you want to make sure that you can help them assess if they're ready. First, the most important factor is the ability to make on-time payments. Next, you can look at their credit profile. And for people who are starting out with no file and no information on there at all, as long as they can be successful with the account, they're an ideal client to build credit with a new account. For those who have maybe more information, you have to kind of look at what's on their credit profile to help them understand if adding new credit accounts will help their credit profile or not. If somebody has what we call a thicker file, meaning that they have already 3 to 5 active trade lines, adding another new account, a credit building loan or other type of account, it's not guaranteed that that's going to improve their score because they might have a lot of other things going on and they might have other more pressing issues that they need to address. And in the next webinar that we're doing in March, we'll talk in more depth about that. If people are in crisis mode, meaning that they have a tendency to miss payments, are struggling paying basic bills, they have high credit utilization, or lots of debts in collection, considering foreclosure or bankruptcy, or at risk of garnishment, it's not a good moment to open new credit. So again, how do you build credit? On-time payments reported to credit bureaus every month builds credit. It's important to think about what credit products will be most helpful, what clients are ready and eligible for, and what the potential is for ongoing credit building. Fortunately, there's a lot more options available now than just traditional loans and credit cards through financial institutions. So there are starter products which are really good for people who are new to credit to help them kind of have a safe way to start building credit. So credit builder loans are very, very small loans that are often offered by nonprofit lenders and by credit unions that don't disperse the loan to the client directly. They actually use it kind of as a savings account that helps them build credit. Also, secured credit cards are another starter product. Social loans, such as lending circles through organizations like Mission Asset Fund, which I have the contact information on one of the last slides. Special purpose loans like assistive technology loans. Rent reporting, so clients can talk to their property manager or enroll in services where they can have their rental payments reported. And finally, the credit scores are actually changing now to address people who have limited credit history to develop new models that help report utility payments and things like that to help them get a credit score. So there's a lot more options now that are available. Okay. So again, just looking for products that are relevant and accessible to clients, that are flexible and affordable, and that have a potential for graduation. So like we mentioned at the beginning of the presentation, once you have a loan that's completed and you've made the last payment, if that's your only account that you have open and you've established a good credit score, but you don't replace it with something else, the credit score could actually eventually go away. And then also helping your clients to assess each individual credit product that they might apply for. So considering things like, what are the application requirements? Do I qualify? What kind of identification do I need to provide? Do the monthly payments, how do those fit into my budget? What credit bureaus are being reported to? Do I understand the terms and conditions? Are there hidden fees or unexpected charges? And do I know who to contact if there's a problem with the account? Places to look, banks and credit unions, especially those that people already have a relationship with. Credit unions don't typically advertise things like secured credit cards and credit builder loans, but you can definitely ask if they have those products, as well as nonprofits and community lenders. I did put together a list of some resources in California that are good, depending on where you are good places to start, such as Self-Help Federal Credit Union, which offers credit building loans and many other products. Mixed Neighborhood Lending, Connecta Federal Credit Union, they have a paid alternative program. Mission Asset Fund offers lending circles, and again, these are this is a model where people get together as a group and save money every month, essentially put it into a pool, and then one person gets the loan or the pool, and that's also can be reported to the credit bureaus. And then finally, MyPath Credit, which offers credit building loans and savings products geared towards youth. Again, stressing the importance of then graduating, because the credit building doesn't end with the last payment on the first loan. It's really all about keeping the good stuff going, keeping that good credit active, and continuing to do that work and to graduate to other products. And ultimately, credit building is one piece embedded in a longer goal of helping clients establish financial security. All right, didn't leave a whole lot of time for questions, so I apologize for that. But I would love to, in the last couple minutes that we have, I'd love to answer any questions that you have. And also just wanted to remind you that in the next webinar coming up in March, we'll talk a lot more about credit rebuilding or credit remediation in terms of helping people address credit and debt issues on their credit reports.
Okay, there's one question from Jose. How reliable is Credit Karma to track your score?
That is a great question, and I can actually flip to, let's see, one of my slides that I skipped. So like I mentioned, Credit Karma is one of the types of services that provides Vantage scores. And so it is reliable in terms of providing that information, but again, it's going to be through a different score model than might be used by a lender. So all of those types of sites, NerdWallet has one, Credit Karma, Credit Sesame, they are real credit scores generated from information from one of the bureaus. So Credit Karma, I believe, is a TransUnion score, but I'd have to double check. So it's going to be a score that is based off TransUnion information. Again, it might be a different score than than your lender might be using if you're applying for a loan, but it's definitely a reliable score to track progress over time. And it's not ideal if somebody needs detailed credit report information, such as they're trying to dispute something and they need creditor contact information. You're not gonna have that when you look at your credit information there. But again, it's really good for tracking general credit progress over time. And another thing, just when you're working with your clients, that when you use some of those types of sites, they do have to trade their personal information in to get access to their credit report information, their credit score, so they need to be aware of that. They also need to be aware that there might be potential marketing messages that will be provided to them, offering them different types of products based on their profile. So it's another thing just to educate your consumers on that they might have those recommendations. And Stephen did confirm that yes, Credit Karma has TransUnion and Equifax scores as well, both Vantage scores. But there's a wide variety of those different types of sites. So they can be great for coaching and for credit education. Just know how to help educate your clients. The other factor with those is that they can also be difficult to access if somebody doesn't have a social security number or has a difficult time answering the security questions that they require.
Great. Thanks so much. Thank you.